This is our third panel. We will conclude after this session. And I think so far it's been an absolute wonderful set of discussions. And I'm very excited for this panel because we're reprising this panel from our previous conference. And some wonderful industry people here today. And so it's very excited. So without further ado, we're going to be talking about a number of different items today, and we'll get some Q&A at the end. But we're going to start to my right. Jeffrey Colon is a professor of law at Fordham University School of Law. His research has focused on international tax and tax issues of investment companies. He teaches courses in corporate, international, and partnership tax, as well as corporate finance. Prior to joining the faculty at Fordham, he practiced tax in Washington, D.C., and he was also the writer of the paper that was highlighted by Rabih, and has been well documented. Elisabeth Kashner, who's joining us from home base out on the West Coast, serves as the director of global funds research at FactSet. She manages analytics, providing classification, ratings, and analytical data. Elisabeth's thought leadership covers industry microstructure and investor behavior. Elisabeth holds a BA from Brown University and a master's in financial analysis from the University of San Francisco. Elisabeth is proud of her work with women in ETFs, where she currently serves as a board member and as co-secretary, and previously served as the founding co-head of the Speakers Bureau in San Francisco chapter. And then on my far right is Zach Miter from Bloomberg. He joined in 2006, and he's written about Wall Street, mergers and acquisitions, money and politics, predatory lending, and tax avoidance. A 2013 article on tax loophole used by hedge fund reinsurers prompted Congress to actually change the law. And his 2014 work on corporate tax avoidance won a Pulitzer Prize for explanatory reporting. So a very great committee or panels we have today. And so we're very excited. Okay, so our first question, and we'll have Elisabeth weigh in on this first, but we'll go out to the other panelists as well. So as we've learned so far, there are significant tax advantages to the ETF structure. Additionally, ETF managers have been able to help tax efficiency through what is called a heartbeat trade. So we talked about that before. And this was a term that Elisabeth Kashner first coined and who has researched extensively on. So Elisabeth, I know the heartbeat trade is fairly technical, but could you provide the audience with a brief explanation of how they work and why they happen? And from a client perspective, what is the difference in the flow process versus mutual funds? And then just on the last piece, what impact did the 2019 exemptive relief rule change have on this landscape of using heartbeats? Thank you.
So many questions, Mac. I'm going to do my best to get to all of them. And greetings to everyone in the audience from Berkeley, California, where the sun is finally up. So just to start, I think we've heard enough today about the ETF creation redemption process and how in-kind redemption is not a taxable event. The heartbeat trade is something that builds on and really amplifies that in an environment where redemptions might be in short supply. So let me back up a little bit and say, if you are an asset manager, nobody really wants to see redemptions. It's a reduction in income. It's a bit of a letdown. But in the ETF space, there's really a silver lining to a redemption in that you can groom your portfolio from a tax point of view. You can get rid of the lowest cost basis, most appreciated securities, lot by lot, if need be, and make use of that outflow. A heartbeat is an adaptation to a lack of redemption activity. Right. And so while on the one hand, lack of redemption is positive, nobody's pulling money out. On the other hand, the redemptions are required for the tax efficiency of the ETF. If you have something with tremendous turnover, like the sector spiders, for example, those have inflows and outflows many times a week, and the portfolio manager is consistently updating the tax basis. But for the sleepier ETFs, where they don't necessarily have redemptions in bulk, and they may not have them at the exact moment that they're needed, The heartbeat is a way to manufacture a redemption. The way it works is a couple of days prior to when the portfolio manager needs that redemption to happen. Usually standard is about 2 trading days, but it can vary. One of the capital markets partners, an AP, which is usually a major investment bank, will make effectively a short-term loan to the portfolio by doing a creation, right? Generally in kind, full replication, no change to the overall economic exposure. But that, the dollars that go in will be, to a very close approximation, what is needed to come out several days later. So the creation leg is relatively straightforward. It works like any other creation. It's just not coming because of capital markets activity by investors. It's coming by this third party, the AP firm, which has a working business relationship with the portfolio manager and the asset management company. The redemption leg comes when it's needed, often right in time for an index rebalance where the portfolio manager needs to get certain securities out, and some proportion of them may have appreciated and therefore would generate a realized taxable gain event if sold on the open market. The redemption is generally split in that anything that the portfolio manager is able to sell at a loss, they will execute directly in the capital markets, or they'll work with a broker, whatever, but it will be a direct sale and the loss will accrue to the fund. But anything that would be a gain is instead placed in the redemption basket very deliberately. This is nowhere near a proportional redemption basket. It's very targeted to the exact securities that need to leave the portfolio that day. And interestingly, like if you ever go look on the trading tape and try to find those redeemed securities, you won't see them because that transaction doesn't hit the tape. Now, whatever capital markets activity the AP needs to do in order to hedge exposure, that's another question. They have very complicated books of business. You never know where they have a balancing trade. You don't know where they're using futures or options or any of that. So the risk profile for the AP is the AP's problem. It's also central to their business, so they know how to manage it. But essentially, a heartbeat is a way to make a redemption appear at the exact time and in the exact amount that the portfolio manager needs. Mac, was that sufficiently clear?
Yeah, I think an example might be where one of my securities gets taken over for cash, big takeover, and so the appreciates almost 100%, and I'm sitting on a gain there. And ahead of the transaction closing, I decided as the ETF manager to ship out that security as part of a heartbeat trade to avoid the taxes of the sale that would occur at the time of the transaction. Is that fair?
That is a perfect example. And that's something where, you know the timing, you know the number of shares, or you know the approximate dollar amount. And so you, as a portfolio manager, can work together with your capital markets partners to make this happen. So you asked earlier about what effect 6C11, the ETF rule, might have had on the heartbeat trade, and Professor Cologne, I think earlier you asked a question about, have capital gains distributions gone to zero in the wake of 6C11? So I took a little look. It's very difficult to actually map and count heartbeat trades. It takes a lot of very detailed, painstaking work. And I think the Villanova staff may have found that out the hard way. But it's relatively easy to measure the percentage of ETFs that make a capital gains distribution in any calendar year. And so I took a look at tax years 2016 through 2023. 6C11 came into effect like the very last weeks of 2019. So 2019, I would consider to be in the pre-ETF rule era, and 2020 would be the beginning of it from a tax point of view. So in the previous era, you could see just not on an asset level, but just on account level, anywhere between 5 and 8% of ETFs making some sort of capital gains distribution. That number dropped significantly in 2020 through 23, down to the 3 to 4.5% level, with a big but. And the but is 2021. We saw a real spike up to 9.6%. And so I found that to be very intriguing. And I took a look at what might have been behind it. There were a couple of answers. The one that I think everybody is expecting is that they're following the mutual fund conversion, and as more and more active managers became comfortable in the ETF space, we saw a rush of active product introduced in 21 and 22. Some of those portfolio managers and their firms and their capital markets desks were either unfamiliar with the heartbeat or not yet comfortable with the heartbeat. And so we saw a lot of those guys just operating business as usual and potentially wondering why they didn't have the tax efficiency that they thought they would get moving to the ETF format. So there's some of that. There's also some very well-established asset managers who just had a big taxable event that year for one reason or another. And often it's associated with having a significant number of difficult international positions. So while most securities can be in-kinded out relatively easily, that's not always true in India. It's not always true with China A shares. So there can be some residuals there. And there are also some asset managers, relatively sizable, who might surprise you, who seem to have made a decision to avoid heartbeats. And others, I think, have sort of started out in the we won't do heartbeats and have since converted. So T. Rowe Price is an example of that, where they had significant percentage of capital gains distributions in 2020, 21, and 22, nothing in 23, and nothing in 24, and they've already sort of published their ETF taxation. I should have said at the outset that this data set is limited to equity ETFs. The bond space is a whole different ball of wax, and taxation and currency and commodities also very different. And I specifically excluded the geared funds, the leverage and the inverse, because they also, their turnover is a whole different thing. But for the core set of funds that I think this audience is interested in, there are still occasionally some distributions, but with careful management and employment of the heartbeat trade, you can run an extraordinarily efficient portfolio, and there's nothing standing in your way from a regulatory point of view.
That's great, Elizabeth. That's a great work. And so to just summarize, it sounds like 2019 it changes, and it sounds like people are more comfortable using heartbeat trades, for some idiosyncratic examples, but managing more tax efficiency as people become more comfortable with some of this trading, as you mentioned. Did you want to say something, Jack?
No. Yeah, I think what's interesting is we can see that the market is clearly becoming more comfortable, right? And then the distinction between pre-19, pre-20 and then 20 on, and then even among different managers becoming much more comfortable in using heartbeat trades. And that raises, again, I guess, a lot of interesting tax policy issues.
So that rolls into I was trying to set it up for my next question to go to Zach. As the industry is taking more advantage of sort of the tax efficiency and the tax dynamics, there have been a number of new entrants that really are also looking at other ways to minimize taxes. And you've written extensively about this. And maybe you could just talk a little bit about your work and how did this tax policy. And I think how we weave this also back into a bigger thing is, our overall discussion today is about taxes and tax fairness and so on. And to the extent that we're getting into some other dynamics around taxes that create a more regulatory catalyst potentially to look at overhaul of the whole system and what could that mean in the future. So maybe Zach, just start out talking about some of your work, and then we can develop that discussion after.
Sure. Yeah. So, I mean, a theme I think is that, you know, the ability to defer recognition of capital gains in ETFs is a really powerful tool. And I think it's one that the markets are only beginning to really explore how powerful it is and all the different things they can do with that. So one example of a kind of new and innovative way is something I wrote about earlier this year, which is the BOX ETF, BOXX is the ticker. So what these guys figured out is, you know, normally in our discussions earlier today, you heard, well, if you get a gain in a stock, you can unload that stock without recognizing a taxable capital gain, but you still have to pay taxes on all these dividends and interest payments on bonds. But what these guys figured out is a way to get what's very similar to a treasury bond-like return in an ETF without having any taxable interest flowing to the ETF owner. And the way they did it is they actually kind of created a synthetic debt product. So it's not actually the ETF's not buying T-bills. They're entering into these box trade transactions in the options market that generate through a series of options a very similar kind of economic exposure and similar kind of yield to a treasury bill. But the advantage is that for tax purposes, these are recognized as capital gains, and so they can use the same kind of mechanics that we talked about earlier for stocks to essentially redeem out their gains and recognize their losses, so that they can report very little, if any, taxable, pass on very little, if any, taxable, items to their investors.
So on the subject of taxes, you have the IRS, and then the framework for in-kind transaction was by Congress.
Correct.
So if we eventually decided that, within the framework of next year that we might make some changes, Professor, why don't you talk about, what actually needs to happen and who's sort of in charge of all these tax dynamics
Right.
as well?
Yeah, that's a great point. As you point out, 852b6 is in the statute, in the code. A couple of things that Bob spoke about using 351, in particular to seeding the new ETFs with appreciated shares. That's actually not in the statute, but in the regulations, which the IRS could change, probably wouldn't, without congressional, impetus. But I think with stepping back, in touching back on Rabih's, I think the first thing we have to do is, in the context of this new budget talks, which are going to go on next year, is get an estimate of really what is the cost of 852b6. We don't have one. Zach at Bloomberg, his colleagues have come up with one. The Joint Committee in 2019, when Wyden's proposal came up with one, but it didn't get published. But each year, there's in the tax expenditure, there's a line item for 852b6, but there's no estimate associated with it. They kind of have an asterisk says can't really be estimated. Well, I think it can be. And then what's interesting is just if it was estimated, it was reported in the Wall Street Journal, it was $200 billion for 10 years out. And now with the work that's going on with the new conversions, with Box, everyone that was is in Box was getting taxable treasury interest before, and now we have $6 billion, $8 billion, whatever now in Box that's not. Sorry, is it trillions or billions? I think it's billions. And then also just the conversions of mutual funds to ETFs. If that number was let's say good back in 2019, 2020, I mean, it has to be a multiple of that now. So we really just need a good estimate to see what is this costing the U.S. And another thing that Rabih's research has pointed out is this really benefits upper wealthy taxpayers. most people, they invest through their 401k, their 403bs, IRAs, Roth IRAs. And so we're really talking about maybe the top 5, top 3% that this benefits, right? And so that's always another question is, if we think, well, we should have ETFs and we shouldn't interfere, they help capital formation. And then the question is, well, who does that tax benefit really flow to? And as Zach has really pointed out, is what started out as something kind of small, A52B6, ETF small, has just now exploded because I kind of call it the black hole. Everything goes in and no gains come out, right? Whatever it is, ordinary income, capital gains go in, appreciated assets go in, but no gains ever come out. And, we see it first with the Vanguard. That's probably the first step, mutual fund class. We're seeing it with the conversions. We're seeing it with now seeding the new ETFs, and then the conversion of ordinary income into capital gains, deferred capital gains through the box. So I think this is something that Congress really has to look at. Again, maybe, there are alternatives. One would be to not permit appreciated securities to go into ETFs anymore, or mutual funds, not permit mutual funds to do tax-free reorganizations. That was given by Congress, but that can be taken away. Without being an academic, I have to say mark to market, but I wouldn't, I'm not going to go there. That would be a great solution. But I don't think without marking every other asset, tradable asset, we don't need to go there. But I think a reasonable, second best, third best solution may be to limit 852b6 to pro rata redemptions, right? If you want to go in and out, we want to, be able to do the arbitrage to enforce the price mechanism and market and NAV, then maybe limit it to a proportionate distribution of all assets. And if you don't, if you're doing the heartbeats, those get taxed. And that would kind of equalize the mutual funds with the ETF treatment.
And what with respect to the heartbeats, is there any risk in terms of tax at this point? I mean, it seems like it's been a slower adoption, and now, more fund companies are getting more comfortable with those tax efficiency. Is there any risk in terms of not being protected by regulations in terms of doing it?
I mean, I think it's been out there for a long time. The IRS knows about it. I've never heard of any kind of action that they've taken. And so in terms of like some kind of action on the part of the IRS to go after taxpayers for that, it seems like they probably would have done that already if they were going to. But it's worth pointing out when Wyden came out with his kind of proposal in 2021, I think it was, he mentioned heartbeats specifically. So maybe if people are thinking about policy, they might, rather than take away the entire A52B6, they might try to do something that narrowly attacks the heartbeat, which would be, obviously that would affect a chunk of the tax advantage of ETFs, but I'm not even sure if it would attack most of it, because a lot of it is just the advantage of being able to use ordinary routine redemptions to get rid of your lowest basis securities.
And you highlighted the box initiative, but and you're saying there's sort of this evolution of trying to discover the tax benefits of A52. What other areas? I mean, we talk about mutual fund conversions, and that's more plain vanilla. But I mean, recently I've heard that there are some hedge funds looking to have ETFs. Or what other? Where's the innovation going as well? What other spaces are people considering it in terms of?
Well, I think, Bob's presentation,
management vehicles.
Yeah, I think Bob's presentation really hit on it, using the contribution of appreciated securities. I know that large private wealth family offices are using these as well. And again, just remember, you do one, but that doesn't mean you can't do the same thing. So today I transform my Apple and NVIDIA stock into a 60-40 ETF. Well, maybe it's for my grandkids. I want 30-70 or 70-30, whatever. You can just take that ETF, as Bob said. You can take that ETF because it's diversified, and then dump it into a new ETF, right? So there's kind of no limit on being able to do this, or do it in a series of ETFs. You got a big position and seed each one of them, each with a different risk exposure. And again, I have a risk exposure today of 70-30 U.S. foreign. Oh, I want 50-50. just seed a new ETF. It's not that hard.
Okay. So I guess we've sort of talked about it. So we bring in the debate. We have a new president coming in January, but there's a lot of focus on reducing the deficits and figuring out more tax revenue. Do you think that this area is going to be more in focus? And where are they going to? I mean, is it going to go after some of the benefits of 852? Is that going to be part of the debate? I mean, a lot of this affects retirement savers as well, kind of being commingled in there. So I was curious, where do you see the organization? And then if you're writing about some more aggressive tax avoidance or tax efficiency, will that be a catalyst to create more debate in Washington about greater reform?
I mean, it's tough to push through a tax reform that would, it's got somebody like the ICI on the other side of it talking about their millions and millions of retail investors, even though most of them are not really material beneficiaries of this, right? Because most middle class people, if they have any exposure to stocks and bonds, it's probably through a 401k, so they don't get any benefit from this. But the industry is just rock solid behind preserving the benefit of 852b6. So it would be an uphill climb, I think, for anybody. And I don't think we've seen any Republican policymakers talking about this. It was only Senator Wyden who's going to be in the minority in the Senate next year. So I wouldn't bet on it.
Yeah, I probably would take the same position as Zach.
Go ahead, Elizabeth.
Go ahead, Elizabeth.
So I agree that it is highly unlikely that a Republican-led budget would be specifically looking to mess with the ETF industry and challenge the taxation of redemptions. But I could see a scenario where it happens, right? And this is very much as a layperson. I should say that these are my opinions and have nothing to do with my employer FactSet. But when we saw the 2017 tax package come through, it wasn't just a series of cuts. There were also some tax benefits that were primarily accruing in the blue states that got taken away. The SALT is the big one that everybody knows. There was also really a tilt towards business owners of certain types of industries and away from things like knowledge workers and consultants. If you think about a blue state, red state split of high net worth and who might stand to be most hurt or most benefit, I could imagine that there could be some Republican interest if there's sufficient analysis showing, showing the distribution of the beneficiaries.
Okay. Great. Why don't we go to the audience for questions?
Taxes aren't that important.
So back to the ETF share class structure, how much it depends on heartbeat trades? In other words, if heartbeat trades were banned next year, would fund families still be interested in following Vanguard's suit and getting these ETF share class structure, because there are costs associated with that, right?
Yeah, I'm not sure about. I mean, let's suppose if you totally ban 852b6, I think that would obviously lessen the benefits of ETF, of which I don't want to be an ETF crank here or an 852b6 crank. There are a lot of benefits, right? A lot of it is lower costs than mutual funds, and again, also the benefit is for not being taxed on other gains of other shareholders. But remember, they do get the benefit of losses. They don't really talk about that much. I just took a list of all the top 25 ETFs, and almost all of them have billions and billions of carryover losses. One question is, if it's all in NAV, why are those losses allowed to be carried over? That might be another thing that Congress could look at as well. But I think it would lessen the impetus to convert for sure. But depending on what type of modification they made to 852b6.
Elizabeth, I'd like to ask another question. You know, it sounds great for all these conversions and let's just drop things into ETFs, but the reality is we're going to have to list these things on the different exchanges. They come with all those requirements, and you know, part of the the spiders is daily liquidity and so on. And I was curious to get your response on sort of, you know, in an era where we had a proliferation of more than the 6,000 ETFs that we have, and just individualized, you know, conversions, et cetera. You know, what does that mean for sort of the end realization on the, you know, the secondary market of dealing with these things and listing them and so on? Do you have any sense of like that being a hindrance to actually the creation and the conversion?
You know, honestly, I wish it were a topic that's considered more in the conversion discussion. And the reason for that is it's twofold, right? In order to have an ETF that's thriving as a product, you need to be in the liquid market. You need to be able to grow and shrink the portfolio according to client demand. Right, we're just seeing a situation unfold right now with some of the geared ETFs that offer twice daily exposure to the price change of MicroStrategies, right, which is nominally a software company, but is actually just writing a whole bunch of Bitcoin on their balance sheet. The geared ETF providers have not been able to get enough swaps to actually properly reproduce 2x the daily returns. They're going into the options market. They're going to hit not necessarily legal position limits, but they're going to hit willingness liquidity limits to take the other side of that bet. It's not really a liquid product. And so, you know, I could see one instance where the solution is to close the funds to creation. And in that case, they sort of inch back into becoming more like a closed-end fund. The other thing that I would say, and this comes from my relationship with liquidity providers, is that there is a ton of client education that is needed. You know, I hear apocryphal tales of advisors who are used to placing a mutual fund order and that's, you know, just buy at the end of the day, easy done. And they're a little bit flummoxed by needing to go in and execute on the stock exchange. And they'll just kind of chase the offer. They'll just put in a market order after market order after market order after market order until they get execution that is so poor that it's going to, you know, wipe away any alpha that might be generated for a number of years to come. So I think the capital markets piece is often neglected at the peril of the asset managers, and sadly, sometimes also at the peril of clients.
What also thing I've thought of, you know, if you have an SMA, you control that SMA, right? But if you convert it to an Act 40 ETF, you're subject to the board as being an advisor. And so you lose control potentially of the, you know, of that thing you answer to a board, et cetera. And so I'm sort of curious as to, that's never, I haven't heard that discussed in terms of that dynamic. Obviously a mutual fund conversion is used to that process, but to the extent that, you know, we're talking about innovation of some, you know, more captive advisors to moving to taking advantage of the tax efficiencies, but it's a public entity, you know, that anybody can buy and sell. I was just sort of curious to get your thoughts on some of those dynamics as well.
That's above my pay grade. I would ask Bob.
Yeah, Dr. Bob. I mean, I'm going to get touched Elizabeth's point and your point is that some of the ones that I've heard about are ones that are in essence quasi-private, right? Once you set it up, you do the 351. If you have the 80% or 50+1, you control the board. And so if you don't have to go out and advertise, you don't really care if it grows any bigger than it is. You really just care about getting into diversification. I have my appreciated whatever monster beverage stock for 20 years, and you know I'm getting old, and I want to diversify. You know, I set it up, I have 50+1, or my family and I, we have 50+1, subject to 40 Act rules and everything like that. I don't really care whether it grows or doesn't grow, right? As long as I get my diversification. But that might be a small, you're right, once the SMAs, once they come in, you no longer have control. There is a board, and they decide on, they make a lot of decisions that you otherwise would have control over.
Elizabeth? you-
Yeah, sorry, the video link is always just a little
Oh, okay.
awkward. Yeah, I would say that the public and private control really matters, and this world is full of trade-offs. The advent of the ETF is an amazing financial technology. I agree with Zach and Jeff that it's really just getting going, and that we will see innovation in the next decade that we haven't even dreamed of, and also a lot of people taking advantage of the strategies that are already present. But everything has a trade-off, right? Like an ETF, you have to trade it in the capital markets, even though that's touted as an advantage. Oh, you can time your trade. Oh, you can short it if you want. It's costly, right? You have the spread. You have any brokerage fees that you might be paying. You could potentially have a premium discount issue. So it's not free. And also trading off control for diversification, maybe it's okay if it's not free. Maybe that's a decision that each investor needs to make.
Okay, so I think I'll just end the session with one last comment. So I put it out there, should the government do something? In the next, let's skip over next year, following. So in 3 years, when we look back, will there be any reforms, more significant reforms today, both on tax or the industry? Or you still see, I've asked it a couple of times, but maybe we could just do a quickly go around. Will there be more major changes between now and say the next 4 years? Go ahead, Zach.
I think you probably won't go broke by betting on inaction and in tax reform generally. So.
Yeah, I would hope there would be, and I would hope it would be maybe not necessarily so narrowly focused just on APT 2B6, but then this seems like hopefully will stimulate discussion of what should be our policy on these investment vehicles, right? Do we need a different way of taxing them, given I think the tax policy concerns raised by in particular APT 2B6. That would be my hope, but I might not bet too much on that.
And Elizabeth?
So I guess I come down in the middle in that I agree with Zach that betting on Republicans to raise taxes in any form is unlikely to happen. We don't know what'll happen in the 2026 midterm, so put a pin in that. But I also think, when you really start to think about, so if I were going to write this regulation, how would I do it? I think that's where you run into technical difficulties really quickly. And you have to think really hard about that. I don't think that a full repeal of in-kind taxation is really on the books. I agree that the ICI would be putting its foot down on that. So I think the idea of just regulating heartbeats is appealing. It has a very simple fairness story to it that I can get to in a minute. But, what we referenced earlier of the difficult work that Zach's team at Bloomberg had to do to identify likely heartbeat trades, and the crew at Villanova and the work that I did, we all sort of resorted to crude statistical metrics. The only way to really prove it is to look at the difference between what's on the tape sales-wise and what's actually changing in the positions day to day, right? And I'm not sure that anybody technically would be able to build the infrastructure to detect that. So it would require additional work and creativity there. But the fairness story might be worth it, right? And that's sort of the difference between the externalities that we talked about earlier and the ETF structure. I think it's super easy to say, like, oh, you shareholder in a mutual fund have redeemed because you are buying a gorgeous vacation home, and you've taken your money out, but the everybody else who has been sitting in the mutual fund, not making any redemptions, just kind of buy and hold, they're getting stuck with your tax bill. I think the average American would hear that and say, oh, that's not fair, right? And the ETF solves that piece of it. Where the heartbeats come in is they take a high turnover strategy and they give it the tax profile of a low turnover strategy. And the American public is paying for that. So I think that's also a very clear argument. So that's why I come down in the middle. I think the profile of people who could potentially be hurt might be considered politically ineffective at this juncture. The fairness story is there, but the execution technically, I think, is extraordinarily difficult.
Well, that's a great way to end it. Thank you, Elizabeth. Thank you, panelists. And thank you for coming.
Thank you so much.